Right, welcome to another walkthrough of the weekly S&P 500 Chart Storm. This is just adding a little bit of extra comment and context around the charts from Twitter. So the first one I think is probably actually the most important one, really. It was actually also the first one from last week, and it's kind of like the battle lines are drawn here. Those in the bearish camp are obviously pretty focused on that bottom line. Those in the bullish camp are pretty focused on that top line. And you look at this pattern here. Even if you didn't use the 200-day moving average, which I've used as like the bottom line, you could just about draw a upward sloping trend line there, or at least a flat one. It meant that, from a charting perspective, it's either a symmetrical triangle or a descending triangle. Bottom line is it's price being coiled up or back, the market being backed into a corner, and at some point it's going to lash out, and probably explosively so. And I think, that when you think about technicals, there's a lot of skepticism around it, but one thing that it does very usefully is provide some objective levels, which can be very useful for both triggers as well as risk management. And from a risk management standpoint, a clean break through that 200-day moving average is obviously downside risk there. So yeah, it's watch this space, this one. It's just keep a close eye on that chart. Now, speaking of backing into corners, this is a very positive piece of news here, the Korean Peace Summit, a very positive step. It wasn't long ago that, America was doing these drills and placing hardware in the region, and, the Koreans were doing all sorts of tests and rocket firings, and it looked pretty sketchy there at one point. Certainly if you look at the history of the foreign policy adventures, kind of sets a precedent for this type of situation. But it seems that we've now reached a breakthrough here with the North Koreans being basically backed into a corner with the sanctions and the the pressure and just the very real threat of action of invasion. And the guys aren't stupid, and they're taking some pretty positive steps here, but it's just the start. And from a market standpoint, this chart's kind of a little bit in jest here. It's looking at the timing of some of the previous inter-Korean summits, and the last two ones were at the top of the market. Also, the last two ones were just playing games, really. They went back on their promises. But it's a pretty positive step, and who's to say how it will end up playing out. But it's a positive step because it takes that risk of war, and it would be very catastrophic and economically meaningful war, and carry a lot more risk and impact than some of the previous adventures around the Middle East, etc. So it's a pretty positive step in that respect, and will have an impact of eroding some of that geopolitical risk premium. I mean, we're still not there yet. Perhaps the Trump summit is going to be the key next step, and for the stock market, that takes, at the margin, it takes another brick out of the wall of worry or barriers to higher prices. And stepping out of the stock market, looking at gold, I've been talking bearish about gold for a little while now, and once you take some of those geopolitical risk reasons for holding gold out of the equation, you could see a bit of an adjustment there. Anyway, moving on to the next one. Speaking of adjustments, this is a place where we have not really seen any adjustment, and that's in speculative futures positioning. We've seen still very heavy longs here, and it was really only a very minor pullback there, and Maybe some of that's just a bit of a rotation amongst traders, so some of them squaring up while others are buying the dip. Point is there that leverage remains high, and that's going to be the theme of the next couple of charts actually. So you look at margin debt, same thing. Slight pullback from the top, but not really much, still very much close to record highs there. Same thing if you look at a broader view of stock market leverage. So this is looking at margin debt in net terms, but also bringing in speculative futures positioning and net leveraged ETF AUM. And yeah, just very minor pullback, and I think this one's quite remarkable. And for the record, if you do look at it against market cap, we'll just quickly have a look at that. Market cap there, is that the right one? Just because a lot of people have been asking the question. So here is what it looks like against market cap. Still pretty much the same message. The build up is perhaps a little bit less accentuated, but against market cap it is very much higher than it was pre 2015-2016 corrections, and higher than it was in .com times. So forget that as an argument that to try and explain it away. And the reason, if you look at it in market cap terms, standardized against market cap, it's pretty useful. That was pretty insightful. But if you look at it in absolute terms, let's look at it here. It's gone from almost minus 100 to almost positive 400. So close to half a trillion of leverage being built up over the last 5 years. And if you think that that's not something to be at least intrigued by, then I don't know what to show you. But anyway, yeah, it's leverage like this can very quickly unwind if push comes to shove. And when you have a big build up in leverage like that, it can fuel and drive price cascades. So it's a background feature to be mindful of. It's as a timing tool, it's not really that useful per se, because you can go to a new high, but if you go to a new high and pull back, maybe that's something to pay attention to. But from a timing standpoint, looking at the acceleration of margin debt is something that I've found to be useful. Things you want to watch for is excessive acceleration, for example at the height of the .com boom, and again at the height of the pre-GFC period, which is quite interesting to see that it's had that excessive acceleration at both of those major market tops. Haven't seen anything of the sort just yet, but we are seeing some deceleration and growth there, and that's the other thing that you want to watch out for, is excessive deceleration, which can be a bit of a bear market trigger or warning sign, I guess. Following that significant acceleration there, you saw significant deceleration, and the moment it went negative, it's pretty much the writing on the wall at that stage. So yeah, if you want to think about how to use this one, at the moment it's really giving a neutral signal really, and the fact that it is starting to decelerate is something to pay attention to. If that deceleration becomes more pronounced, then that's definitely the type of thing that would make you become actively nervous. That's just the margin debt as percent of market cap, because somebody asked about it, so I put that one in there as well. Next one, this one's kind of a peculiar chart. It shows you market leadership, and here it's saying S&P 500 sectors that have outperformed 2 months in a row. So when you have a really low reading of this, it basically implies that you've got very concentrated market leadership, and vice versa. It shows you that the leadership's more broad when it's higher. And why is that relevant? Well, because we saw it kind of get to these levels at some fairly hairy points in the past. .com 87, is it 87? Not sure, but anyway, Thinking about what it actually means, when you get excessive leadership in a particular set of sectors, or one, it could mean that there's a bit of weakness in the other sectors, which, there's definitely something to be mindful of. The other thing is, when you get excessive leadership, it can point to frothiness in those sectors. So, telcos and technology, and, at the peak of the dot-com 2000, and, well, pretty similar now as well. Moving on to some fundamentals for financials. This is a look at operating earnings. So I think about a quarter of companies have announced so far, and at the moment it's running at a pace of growth of 24%. Pretty solid. We can debate about whether that's going to be able to maintain or what the future pace of growth is, because I guess that's kind of one of the key arguments there is, yes, earnings growth is really good now, but will it be good a year from now, 6 months from now? Hard to say. One very, very interesting chart here, took me by surprise actually, is how much capex growth has been surging. And so, this is obviously the tax cuts are playing a big role in this. And, there was a bit of questions or wonderings about what's going to happen with the proceeds from the tax cuts. Is it just going to be showered on investors in the form of buybacks and dividends? Or is it actually going to go into, R&D and corporate capex and all those good things? And we're seeing some early signs here that it's indeed going into capex. So, companies been probably delaying some of this for quite a while. It's been that sort of stagnant growth period for quite some time, and only recently the growth's really been surging and picking up, not only domestically but across the world. And companies been making do by just doing more maintenance, just stretching the current capacity and sticking with old equipment. But now it seems they are, now that they've got a bit of boost in funds, they're deploying that. And the other thing is, you look at capacity utilization, industrial capacity utilization starting to tighten up, labour market capacity utilization is very tight. So, from an economic standpoint, it certainly makes sense that companies should be investing in capacity expansion. And final chart, just a bit of a funny one really, is market cap weighting by first letter of ticker name. Probably the concentration in A's has something to do with one particular company there, which had a pretty good earnings report. But anyway, I'll leave it at that, and yes, we'll go back to the first chart, and yes, the battle lines are drawn. So this chart, becomes particularly more important when you think about a lot of what we talked about in the session. There are some late cycle signals. There are, some things to be perhaps nervous about. And, those forces are the blue line, keeping a lid on things. These investors introducing selling waves of pressure when it approaches those levels. On the bottom side are the ones who are focused on the fundamentals, the earnings, the capex. Turn around in geopolitics, at least in some corners of the world. Introducing buying, whenever it gets to that 200. And the battle lines are drawn really at this point, and we probably won't have to wait that much longer to see which side's going to win in this this here skirmish. So I'll leave it there, and yeah, be sure to subscribe to the channel if you want to keep up with future updates, and if you had any comments or questions, do go ahead and put them in the comment section below.